Hello, everybody. 'Tis I, the Rumpled One. It is Monday, January 29th, the year 2018. Let's talk trading. Waiting. Trading's about 98% waiting for your trigger, something to happen. I've talked about this before, but it bears repeating. You just have to wait for your trade to appear, your trigger. You don't want to rush into it. You want to be like that leopard or cheetah in the bush. You just wait and you just wait. And then when you see that weak antelope or that young antelope, then you pounce. But part of waiting, or one thing to do while you're waiting is you look for reasons not to trade. In other words, sometimes it's just not the right time to trade. You look at the pair you're trading, and for whatever reason, you decide it's like, no, I'm not going to enter a trade right now. I'm going to sit back and wait. And that sometimes is a smart thing to do. It's, to paraphrase Cool Hand Luke, my favorite movie, sometimes nothing's a pretty cool thing to do. But human nature being what it is, it gets the better of us sometimes, and we just have to jump into trade even though we don't have triggers. Even though we know we're supposed to wait. It's part of losing focus. Or sometimes we're not quite paying attention. We're slightly distracted. We miss our entry and we get in a pip or two late. And sometimes that's the difference between exiting with the profit and exiting with the loss. Sometimes it's just that razor thin. So let's take a look at the charts, and maybe we can see some reasons why we shouldn't enter the trade. But first, money and risk management. I know those of you who watch the videos every day, and I thank you, you're just going to have to bear with me, but maybe you need to hear this or see it, because I don't really read it every day, but it is simple. Okay, the gap. Look at that. They all filled, and if you remember yesterday or earlier today, depending on where you live on this planet, there was a couple of 40s. I don't remember which pairs there were, but there was a couple of late that weren't filled. And if you took those trades, you'd be in profit right now. Once again, it was simple. The time between yesterday and today, all you had to do was fade that open gap, meaning trade towards the previous weekly close. You would have picked up the pips. And, talk about waiting. Well, I think I put that video up about 2 hours after the weekly open. And sometimes we know that the spreads are kind of wide, right, when the session opens for the week. But, sometimes you just sit back and wait, let things settle down. And, there was 4 opportunities to make, I think, 20 or 40 pips. It's just that simple. Just all you have to do is just wait, let things settle down. Does it always fill? No, because the previous week I think we had 2 that didn't fill. But, 2 out of 28? That ain't bad. So, that's what we wait for. We wait for opportunities. Here, looking at the daily chart, you can see the pound pairs. I must have had some news last night. They've all moved 100 and some pips. So on this chart, we can see we're looking at yesterday's high and low, and sometimes you just wait just for price to break out. So here, price opened here. There's you had a long wait for your trade right there. Or maybe you just say, hey, the daily's moving down at this horizontal line. I'll just jump in there and see what happens. And waiting to exit, sometimes you have to wait to exit too, because you have to give price a chance to get to where it needs to get to. It just does, and it doesn't necessarily move in a straight line. As you can see, it's kind of a jagged or squiggly line. And so, looking on the dashboard, looking at here, if you're a rat trader, you wait for price to be in the zones where you can trade. If you're a buy zone trader, you wait for price to get to the zone. Here, it never left the zone, so you would have been stopped out there. Maybe if you even took that first hour trade, but here you got a payoff, and then you just kept getting payoffs here. But the thing is, you're not really trading 24/7, and I wouldn't even put a robot up there 24/7. You want to look for your better opportunities. And so, that being said, wait for the better opportunities. And here we go, rat zone. Here's an opportunity right here. We wait for the zones, for price to range, and then we wait for that to make a low and to reverse off that daily low right there. So you see here, price, you can barely see it. That's why I used to have this as blue, because the greens kind of fade into each other. Maybe what I can do, for those of you who might not know how to change colors, what we can do here, if we change this to black, the bar up, bar down, and you can see the black lines. Hopefully you can see that better. But you see here, price failed to make a new low, turned around, went green. You could have jumped in, and there you have it. Of course, you could say that's hindsight, because yes, price could have went there, could have come right back to the open and crashed down. But it didn't happen. But it could have, and that's why you have stop losses. So for all of those people that always look to find something to pick at, there you go. And now the pivot point. Here we go, the purple line. As you can see, price open, went through the pivot, and has reversed. We came right down to S1 for the day, went through it twice, reversed off of it. So for the pivot traders, there's your trade right there. Once again, but you had to wait. There's the weekly pivot. This purple dashed line right there. The future pivot point, price will probably, it's heading towards the future pivot point as we're watching. So that's what you're gauging for. And price action. You can wait. You can wait for a 3-ball to appear. And then once again you take the trade. So here you would have been triggering long at 23.70, green right there, and you'd be down just a few pips, and you're waiting for price to move in your direction so you can exit with the profit, or you're waiting for price to hit your stop loss and take you out of the trade. Now, we've also got the 5 lines. Here we go. As you can see here, price hit the previous session's close and then reversed and headed back down. This would also be known as the wick zone. Price doesn't like staying in the wick zone. So in this case, if you were going long and you see price enter that wick zone and stall, you just might, and then come back out, you just might want to exit right there where it just came back out, because it's telling you that this could be hard rowing right here. Once again, looking at the wick zone, you can see it clearly here. And the holo zone, you see it made a lowest open and then went up a few pips and it's coming right back down. As squigglies, we'll just move on by. I know some of you really hate that. And you can see it here from when I opened the charts this morning. Price went up, now price is down relative to when I started. Okay, the do not trade indicator. I wrote this a while ago. In fact, I'm bringing it up here in the editor. Yeah, way back in 2009. 2009. And what does this do? Well, if you want to use squigglies, it has that. We'll skip over that for now, though. So what it's saying is, did price close above the previous high? Did it close below the previous low? You can only have one of those. Can't do both, right? Unless it was a unless there was no movement, that the high, the open, the high, and the low were all the same, and the close. Now, did price cross above the previous high? So if the open below and the close is above, it crossed above it. And so this is a live indicator. So meaning, you know, we're looking at it right at the moment. It's real time, as opposed to something that once it plots, that's it. Because it's a multimeter. And close below the low, cross below the low, open above the low, close below it. Is the candle green or is it red? I know for you, for those of you who know logic, yes, I could say not green is red, but notice I don't say greater than or equal. And ditto with the above the previous mid or below it. That's why. Plus sometimes it's just easier to read, and with the speed of computers today, we're not really processing that much, so it's not going to drag the CPU down. So then, if any of these conditions are true, then we're not going to want to short. And if any of the conditions are false, or I'm sorry, if any of the other conditions are true, then we're not going to want to go long. So this indicator is just basically telling you not to trade a certain direction. So you can see here, looking at the 1 minute chart, it's saying don't short. And looking at all the others, it's telling you don't go long. So what does this mean? It means you might want to wait. It also means you might want to pick a different pair to trade. Or it might mean if you go long, take your profit quickly. Any sign of weakness you want to reverse. Once again, waiting. So while you're waiting, especially if you're in a trade, look for reasons that you should be exiting. And if you're not in a trade, look for reasons why you should continue waiting. And it just might help, because usually you're looking for reasons to jump in. But if you say, no, I'm going to look for reasons I shouldn't be trading. Oh, okay. Why shouldn't I be trading long? Why shouldn't I be trading short, depending on which direction you're looking to trade? Because usually when you're waiting, you've already picked a direction. And now I might have to do a whole video on that one. I think I will. Picking the direction to trade. And just remember, fellow traders, it's not what you trade. It's how you trade it. TheRumpledOne, off the drain to banks.